All right, today we are looking at how bond values change over time, okay? Now, one of those things that we think about is a little bit of a hard concept to come over initially, but is that the actual value of a bond, it can fluctuate, okay? And when I say it fluctuates, meaning the amount that you might sell this asset for can change, okay? So the way I would like to start this discussion off is, let's say I issue a bond. Okay, my corporation, DeHan Associates Incorporated, okay, decides to issue a bond, right? And we have an issue bond, and each individual bond has a face value on it of $1,000. Okay, it has $1,000 face value. Okay, and then we are going to pay a coupon payment. Okay, we're going to pay a coupon payment on that of $100. Okay, which means, right, what is my coupon rate there? $100, and excuse me, and this is an annual payment, okay? That means that my coupon rate, my interest rate I'm paying is 10%, right? $100 of $1,000, right, is 10%. So it's a 10% interest payment, okay? So my interest rate here I'm paying is 10%. That's the current market rate for my going debt, okay? And then also, let's say that we have the market interest rate, right? Our interest rate today is also at 10%. So I'm paying the market rate, okay? And then let's say this is a 10-year bond, right? It's a 10-year bond. We're just keeping these all simple. We have a 10-year bond at a 10% coupon rate, a 10% market rate, a future value of $1,000. That means that my present value is going to be what? It's going to be equal to our face value, right? It's going to be equal to $1,000. Okay. If you don't believe me, look back at the previous videos and solve it through, right? But the reason that our present value is equal to our face value at $1,000, and the reason I didn't even need to put this in a calculator, is because our interest rate equals the market rate. Okay. Now, this is something that is very, very commonly mixed up by students, okay, is that we think about the discount rate, the interest rate, the coupon rate, all these rates, and they kind of get a little bit confusing. Now, when we think about this, is that the coupon rate, okay, this is the amount that I'm making in interest payments, okay, on this bond, okay, it has a $1,000 face value, and then I'm going to pay the interest on the principal, right? That face value, right? This we can also think of as the principal, okay? Is that we're paying on our principal a interest rate. That interest rate here is at 10%, okay? That interest payments are at $100, okay? Contrast that with the market rate, okay? The market rate is just what I could walk into the bank and get a loan for today, right? It's just what the going rate is. This is what an investor, right? This is from the investor perspective. This is what an investor has to receive for loaning me money, right? Because I'm issuing a bond, that investor is loaning me money. Okay, so that's what that investor is going to receive. So there is a very, very big difference there. Okay. Now the challenge comes. The challenge comes when market interest rates change, okay? Let's say that the Federal Reserve starts expanding the money supply, right? And if you're not familiar, if we start expanding the money supply, that means that interest rates are going to fall, right? I issue this bond, okay? 1 year later, interest rates start to fall, okay? And let's say the comparable rates now become, okay? So R, this is what the market rate is, okay? R is going to be at 9%, okay? How much am I paying on my bond? Am I now only paying $90? No, I am still paying $100, right? Because we entered this contract a while back, and it's saying, hey, I am paying $100 on this bond for you borrowing this money. I am making this payment of $100. Okay. Similar, think about your car payment, right? When the interest rates fall and let's say you have a $300 car payment, you can't just call the bank and say, hey, I'm going to pay you $260 this month, right? That's not going to happen, right? The bank's going to kind of laugh you out of the place. Okay. So the interest rate can change, but the amount of my payment remains constant. Okay. So when we're doing this is that we should be looking at this and saying, all right, what is this bond going to be worth? Okay, is this bond, right? So this one here is trading at par. Is this new, so before the interest rate change is trading at par. Now that interest rates have fallen, okay, what is going to happen to this bond? Okay. Now think about this. If I issued this bond today, then that means that my interest payments, my payments would be equal to $90. Okay? But instead, whoever is holding on to this bond is receiving $100. Would you rather be getting paid $100 or $90? Duh, you'd rather be getting paid $100, right? So this one over here on the left, this is more valuable, okay, than the one over on the right, okay? The one on the left is more valuable than the one on the right, okay? So the important thing here that we're going to be looking at here is that what is going to happen to the price of this bond, right? Because we can sell this bond in the secondary market. Is the price of this bond going to increase or is it going to decrease? The present value of this bond. The value of this bond, is it going to increase or is it going to decrease? The investor's getting paid 100. Everyone else is getting paid 90. So that means that the price of this bond is going to rise. Okay? Makes sense? I hope it does, but we're going to do another example here next.